Welcome to the Real Estate Guys radio program. Thanks for tuning into the show. This week we're talking apartments, multifamily investing in real estate. What's it take? How do you make the jump from single family to multifamily? And should you? Lots to cover today on the Real Estate Guys radio program. All aboard. It's last call for the Real Estate Guys 14th Annual Investors Summit at Sea. Nearly sold out. There are just a few spots remaining for you to spend a week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, international developer Beth Clifford, attorneys Mauricio Raould and Jeffrey Verdon, and the author of The Creature from Jekyll Island, G. Edward Griffin. New for this year, commercial mortgage broker and syndicator Michael Becker, and Ken McElroy's partner Ross McAllister. And joining us live and in person for his third Investors Summit, Robert Kiyosaki. It all begins February 26th in Miami, so hurry. Visit realestateguysradio.com and click the tab that says Summit at Sea to learn more and reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit at Sea and make plans to spend a week with the Real Estate Guys, Robert Kiyosaki, and an all-star faculty on the 14th Annual Investors Summit at Sea. Welcome to the Real Estate Guys radio program this week in Dallas, Texas. Yeehaw. Let's say hello to our financial strategist and co-host Russell Gray.
Hey, Robert.
Always fun to come to Dallas.
It is. I love Dallas.
Yeah, fun town. Lots going on here. In fact, a few weeks back on our predictions for the year, which isn't our predictions actually, but just us citing lots of different sources, you may remember that one of the reports showed that the number one market across many, many sectors poised for 2016, according to all the respondents of the survey, was Dallas, Texas. So we said, you know what we got to do? Get in a plane and come here. So we've got a show here. And next week, actually, we just got to Dallas. So we're going to spend some time visiting some of the folks that we know here. And next week on the show, we'll do a market update about this marketplace. So stay tuned for that. Today, really what we're talking about is based from a question we got from a listener, which had to do with single-family houses versus multifamily.
Yeah, I think when everybody thinks of real estate investing, the most simplest way to begin is in residential, right? We all understand residential real estate. Most of us grew up in homes, have owned homes, maybe have rented homes or apartments. We get it. The easiest thing to do is buy a single-family home because it's the thing that we tend to gravitate to and understand. And you can make the argument that over the last few years, it's been a great investment for rental. But apartments have been super strong as well. And so if you've ever played the game of Monopoly, you know the name of the game is you run around and collect those little green houses. And when you've got enough of them, then you move up to a big red multifamily or a hotel. You know, the big red hotel they talk about in Monopoly because you can get more income for your purchase price, right? It just provides better cash flow. So multifamily is kind of the first big step that a lot of people take going to the next level in real estate investing.
In fact, on our summit a few years back, we did a panel discussion on this very thing, how to go from little greenhouses to red hotels. And on our panel were Ken McElroy, whose first investment property ever was a little 2-bedroom. And he was on the panel. And of course, today, thousands and thousands of doors that Kenny and Ross control. Kim Kiyosaki was on the panel. She started with a little 2-bedroom unit. My dad, Bob, the godfather of real estate, he was on the panel. And of course, he started with a little 2-bedroom unit. Myself, I started with a duplex. Each side had 2 bedrooms. So I'm kind of an overachiever. And then, of course, we had Tom Wheelwright as a CPA talking about the product types. And the reason I bring up what everybody started with is that was the path all these super successful investors had taken. They started with a little greenhouse. And so how do you get from that, or do you even need to start there to get to apartments? That's what we're going to talk about today, and how apartment investing differs. When I rent a single family house, probably the biggest difference between that and a multi-unit is the possibility of use. The vast majority of single-family houses in most countries are occupied by people who live there. That's their use. Now, we talked about forced equity a few weeks back, and we talked about the idea of conversion, and there are certainly places where what were formerly single-family houses today are doctor's offices or other offices because of the way that the development in a town has grown up over time. But the idea of multifamily is that it was built with only one purpose, to rent out units. Very hard to buy an owner-occupied 20-unit building.
Right.
Because most people aren't going to do that. Now, 1 to 4 is a financing category that would allow for someone to live in a property. And it's possible you could live in a unit like I did in my duplex and rent out the other unit. But for the most part, multifamily is a different animal because it has only one exit strategy. That is, you're selling to another investor.
To a large degree, buying multifamily where you're only dealing with investors is actually a little bit safer. And here's why. When you go to purchase a multifamily property, you're bidding against other investors. These are people who tend not to overpay based on the math, right? I mean, there's going to be a variation. If people really want something, they can overbid. Anybody can overbid. But when you're bidding on a single family home, you're bidding against owner occupants. And you've got a government that's creating an environment that's really trying to stimulate home ownership. And so they give you subsidized loans. They give you high LTVs. And when a homeowner is looking at a home, they're not looking at the rental value of the home versus the purchase price. That doesn't have to make sense to them. They're looking at their own income and the ability to leverage that through an owner-occupied mortgage, which always has a lower interest rate, and then that affects the value. So when you're bidding for a single-family home that you want to rent out, you could be bidding against an owner-occupant who's willing to bid above what the rental value would justify. And so it's really important that you understand that when you're bidding on single-family homes. The flip side of it, though, is on your exit. Because when you go to exit a single-family home that you bought as a rental property and you go to sell it, there's the potential you could get a higher price than the income would justify because it's become a hot owner-occupied market. You're probably not going to have that happen with a multifamily property.
In fact, you might already have your buyer renting it from you. Very common that a renter figures out a way to get to the cash and credit they need over some time period. Things like lease options can be tools for that. But really, when it comes to apartment investing, there's some basic things that are the same as single-family houses. People live in your building and pay you rent. That part's the same. Where it gets different is in several areas we're going to concentrate on today. The first has to do with the location. Properties, single-family properties are often coveted by location. So a particular school district or a particular part of town. With multifamily property, there are those distinctions, but they may not be as clear-cut. And one of the nomenclatures that we use for multifamily is A, B, C class property. So you hear people say, well, I bought a B class apartment building. And what is that? Does the apartment council come out and grade your building? No. Here's what it means. An A class property and a multifamily property is generally the newest, nicest, best quality property you'll see in multifamily. These are the big, fancy apartment buildings in the best parts of towns, often with the greatest amenities. They have pools, they have elevators. It's high demand rent. That's A class. Now, A class can be great because of the value of the asset and because of the surety of the rent. The challenge with A class tends to be they don't perform as well.
Right. Well, it goes down to people paying more for the quality. Quality things cost more, and they may not necessarily rent for a proportionate amount more. But the owner would be willing to take on that because they're going to get a better quality demographic. They're going to get a better quality facility in terms of its longevity and condition. They're going to be in a better neighborhood that will continue to demand above average sales prices, right? And so these are investors who are willing to take a smaller yield for less hassle.
All things being equal, A class is the least amount of return, ROI, on a property, and they tend to be big. So who buys these things? Usually not you and me. A class apartment buyers are pension funds, insurance companies, real estate investment trusts, big behemoths of companies and groups of folks who go and buy these buildings and just hold these assets for a real long time.
And they also, because of their size and experience, they have the ability to operate on better margins because they're able to operate more efficiently. They have economies of scale that, a mom and pop operator just doesn't have. And often they have a low cost of capital, and sometimes, many times, they go in without any financing, right? So they're just looking for raw return on investment. They pay cash for the property, and then they just look at the net operating income as a yield on their capital, and they're very, very happy. You can imagine an environment right now where we're getting yields on treasuries, 1-2%, 2.25%, whatever is considered pretty good. If you can get 4 or 5% or 6 or 7% yield on a property like that, that's very attractive.
Now, once an A-class property kind of falls out of favor, it's a little bit older, maybe 20 or 25 years older, and it's not the newest, nicest, shiniest, that becomes a B-class property. C-class properties today are typically 1 or 2 stories. They maybe not have the same amenity set. They're nice places to live, but they're varying in their degrees of quality, because if I own a B-class apartment building and I continually keep up the work on it, it could be just as valid as an A-class today. Meanwhile, there's lots of B-class properties that have fallen out of favor, lazy landlord syndrome. The coverage of the debt is easily by the current tenant, so we don't have to do much work to change that. And so there's opportunity for investors at the B-class. We often talk about the model that Ken McElroy uses from MC Companies, and wrote the book, The ABCs of Real Estate Investing and the ABCs of Property Management. Kenny, this is what he does. He finds undervalued B-class apartment assets and increases their value. So that's a B-class apartment building. C-class is a more specific definition. It's a property that's deemed to be at its highest and best interim use, but not its current use. So that's a whole bunch of words. Let me explain that. The appraisal community goes out and looks at highest and best use. The problem an appraiser is trying to solve, and that's what appraisers do, is they solve problems, is the valuation problem that's posed by a property and what is its highest and best use. The extreme example is I go to an appraiser with a raw piece of land and say, what's the highest and best use for that? They're going to look at the area and they're going to give you some ideas. It's not the same as a company that you would hire for that information, but they'll tell you that, and part of its valuation. So a property that's its highest and best interim use, according to the appraiser, means that it works fine the way it is now, but what really it should be done, the highest and best use for the property, is to scrape it, knock it down, rebuild it. But the interim part is this. That may not be financially viable today. That may not make economic sense. That may not be functionally obsolete yet, but it's on its way there. So slap a coat of paint on, put some new carpet, rent that thing out, and it's going to work. So those are C-class apartments. Lots of money to be made in C-class, but what tends to happen is C-class buildings are often built in the 60s and 70s and in tougher parts of town, and over time they've developed a reputation.
Yeah, and maybe when they were built, they were nice parts of town, but parts of towns shift. You know, we go out and do the Memphis field trip. They talk about the white flight, right? And this is just a term they use to talk about how everybody from downtown moved westward out into the farther suburbs, you know, and then the downtown got a little bit more blighted. Of course, it's been starting to revitalize, but, you know, when you have those demographic shifts, sometimes you're building, you can have a B property and take really good care of it, but what's going on in the neighborhood around you, you don't really have a lot of control over, and it's sliding down the scale, you know, B minus and pretty soon C plus and then C, and you're not able to attract, because of the shopping, because of the schools, because of other amenities in the area or the demographic, you're just not able to attract the kind of tenants that are going to pay the kind of rents you need to have to be at a certain level. And so you end up with properties that fall into disrepair, and then they attract a different demographic, and you look at the cash flows, you say, well, gee, I can buy this property so cheap. That's because nobody's bidding on it relative to the rents that are coming in. And on paper, it looks fabulous, but you have to really factor in, when you're down at that level, a much higher rate of expense, because you're going to have more turn, you're going to have more collection problems, you're going to have other issues that from a management standpoint. Now, with that said, there are people who are absolute specialists in dealing in that demographic and in that particular product class, and they can make it work. It's not for the faint of heart. It is not for the inexperienced, but there can certainly be money made there. So A, B, C, those are the different categories.
All right. And you know what? C-class you can make a fortune in, but you better know how to operate that. It's like the difference between being able to drive a car and driving a tractor trailer. It takes a different level of license, expertise, practice, all of that. But a lot of folks love C-class. I spent the early part of my real estate career in C-class. Got to love C-class. Today, happy not to do as much C-class, but folks are great at it, and you've got to decide. So that's one of the distinctions of property. The other primary difference when it comes to apartments is financing, and we're not going to spend more than 60 seconds on this, but the categories of loans available for 1 to 4 unit properties, completely different than the lenders and the type of loans available for 5 units and above when it comes to multifamily. So great resource to that is go into the Real Estate Guys archives and look for a show that we did with Michael Becker, who is a commercial lender who lends on multifamily. And you can really get the distinctions between the financing. But financing has a lot to do with multifamily because it isn't as easily changeable as single family financing is. So that's another big difference. We're talking about apartments, and does that make sense for you? As multifamily investing makes sense? When we come back, you're going to meet an amazing man who was the National Apartment Association Investor of the Year a few years back. He owns lots of apartments, and he's going to show you why he thinks it's the best asset class in real estate. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hi, this is Patrick from Paradigm Life. I've recently written an ebook called The Perpetual Wealth Strategy. The ebook discusses one of the best investments, real estate, combined with a financial vehicle used by the wealthy, many U.S. presidents, famous actors, athletes, and even Houdini himself. You can download the ebook for free in the resources section on the Real Estate Guys Radio homepage. Don't wait. Go download it now.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Garrett Sutton, Rich Dad's advisor. Remember, equity happens, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. We're talking apartments today, and a man you're going to meet here is going to break a myth long held by real estate investors. But first, let me tell you a little bit about him. In 2012, he was named Apartment Owner of the Year by the National Apartment Association, which means he's pretty good at what he does. Let's say hello to Brad Sumrok. Hey, Brad.
How you doing, Robert?
Great. Thanks for taking time today to talk to us about apartments.
I'm excited to be here.
We're excited to hear your story because most folks think you have to start with houses. You buy a house, you buy another house, you buy another house, and then pretty soon one day you're going to graduate up to apartment investing, and yet your very first investment was an apartment building. Tell us about that.
That's right. Well, I used to think that too. I thought I would buy a rental house and then a duplex and then a fourplex and then an eightplex, but my very first deal back in 2002 was a 32-unit building. And then I actually went bigger, and it's actually easier as you go bigger, which is sort of counterintuitive for a lot of people.
Well, it is. This is a huge paradigm to break. Well, wait a minute. More units is easier? Explain that.
Well, you know, when I had after I had about 1,000 units, I actually went out and bought one rental house. And with the rental house, I had to do the property management. I had to meet the tenant to sign the leases. I had to collect the rent. The tenant didn't pay me and there was an eviction. I actually had to go and do an eviction, which I didn't know how to do because when I owned apartments, I had a management company and a property manager that did all that for me. So it was actually easier for me, believe it or not, to manage 1,000 units than it was one rental house.
That is such a great story. So let's talk about how you got into the business, because you kind of have a corporate background. Talk about where you were and what made you gravitate to real estate.
Well, I grew up middle class in Pittsburgh, and I was taught to study hard and get good grades. My dad never finished engineering school. He had 3 years of engineering school, and my dad's boss was an engineer and made good money, and their family went on nice vacations, and we didn't. So I decided I wanted to be an engineer when I grew up. Through the encouragement of my parents, I studied hard, got good grades, went to engineering school. Didn't figure out until after I became an engineer that I didn't really like engineering.
Whoops.
Went back and got an MBA because that's what society and that's what they taught me to do. That's what we do, right? You want to move up in the corporate world, you go back for more school, more training. And after I got an MBA, I actually made more money, but it didn't teach me any business skills or how to be an entrepreneur or even give me the mindset or desire to be an entrepreneur.
Right.
So I was an employee. I made good money. You know, I would see these ads in the newspaper about going to real estate seminars and learning how to get financial freedom, and I thought they were kind of hokey, and I didn't want to go. And but the thing is, you know, I read this book that a lot of people know about, and the book is Rich Dad, Poor Dad, a very famous book. And that book changed my life, that whole paradigm shift of being a business owner, being an investor, ESBI, the cash flow quadrant, And that mindset shift for me was huge. And so that opened my mind. It enabled me to go to a seminar and invest in specialized education, not like the education you get in school where you learn to become an employee.
Right.
You learn to become an investor. You learn to become a business owner. And that's how I got started.
Well, it's interesting because you were able to invest part-time, still with a job, still building up your portfolio, but pretty quickly you were able to replicate your income from your job. So talk about how fast that can happen.
Well, I help people retire in 5 years or less. Now, I did it in 3, and I'm my first success story.
Yeah.
So now I have students that are doing it anywhere from 2 to 5 years, and some people were like, well, Brad, I love my job. And I'm like, well, you don't have to quit your job, but you could just expand your means and have more income, more freedom, more security. But many of my students were like me. They feel like they're in the rat race. They make good money. They can't just quit. They have too many bills to pay. And the other thing I love about apartments is that it just takes too many single-family rentals. I mean, look, if you're making $80,000, $100,000, $120,000 or more a year, how many rentals, single-family rentals, does it take to replace your income so that you can walk away from your job?
Yeah.
So when I learned that, I figured I needed like 40 or 50 houses. And then I'm thinking, they teach these formulas. If you have to have 50 houses, you need to make 500 offers and analyze 5,000 deals. And I'm thinking, God, that just seems like so much work. I could buy one building, have all my units under one roof, hire professional management, and I don't have to quit my job. So that's exactly what I did, and that's exactly what people that I train do. So I would say it's a 2 to 5 year process.
Yeah.
It's a 2 to 5 year process.
So what are the things that you need to learn? If you already know a little about real estate investing, I know there's a lot more as you get into apartments, right? I started in the apartment space as well, and it's a lot. So how do you break that down and make people understand, students, potential students, people listening on the air, hey, this really, there's a lot to learn, but it can be learned.
Well, it's like any other recipe, and what I tell my students is if you have the ability to follow a simple set of instructions, then anybody can do this.
Yeah.
And it could be I could teach people how to analyze deals, how to find deals, and then the question is, well, where do I get the money? And so one of the things we do is we teach a syndication model where people could raise money from other people. So a lot of people, that's the other paradigm shift is people think, okay, Brad, I love the economies of scale from apartments. I love having all my doors under one roof. I love the fact that I don't have to buy 40 or 50 of these to retire, but now where am I going to get the money?
Right.
And so many people have a limiting belief that money is hard to find, and I could just say that if you find a good deal that provides good returns, which to me is double-digit average annualized returns and double your money in 5 years or investors' money in 5 years, people will invest with you. And then you just got to find where to go to find those people.
Well, in fact, you talked today specifically about the 3 different ways that you can invest in apartments, because it's not just one way. You could certainly buy an apartment building for your own account like you did your first time out, right?
That's correct.
Or a lot of folks today get that apartments are better because of the economies of scale, because I can be diverse across multiple marketplaces, but a way to do that is to invest passively in one of these syndications you're talking about.
Yeah. So passive investing is awesome because, you have the opportunity to make great returns, double-digit average annualized returns with truthfully little to no work. And the work that you need to do as a passive is you need to be a sophisticated or accredited investor because that makes you SEC compliant, which is important.
Very important. And then the third, of course, is if you wanted to be that very syndicator. And I know that as you have increased your portfolio, that's a lot of what you do. You'll put deals together. We've got your own money in, but you also raise money from other folks.
Yeah, and being a sponsor is a great way to even fast-track, that early retirement because sponsors, I put money in my deals. I teach my students to put their own skin in the game. You have more credibility. But you also can make more money than simply the return of your capital investment because sponsors are doing the work. And they are, investing more in their education. They are spending more time. They have more responsibility. So for the people that want to, and this is not a full-time commitment to be a sponsor, by the way. I've sponsored many deals when I had a full-time job. But being a sponsor is not passive. It's not a completely passive investment, and I need to let people know that. But being a sponsor is you not only make a return on your money, but you can command an additional form of compensation, whether it's an asset management fee or additional equity in the deal or something like that, for the expertise and time and effort that you put into the equation.
Well, I think especially in apartments, you see it's an eventuality that a lot of folks get to the point where they're kind of deal junkies, right? They like looking at a lot of deals, but at the same time, once I've got 3 or 4 or 5 buildings and my cash flow is kind of good, but maybe I've run out of my personal, investment capital, why not bring other people on board? And because of the nature, the size of the deals, you usually do need several $1 million, as a down payment on some of these deals.
Exactly, and there's everything right with buying your own deal with your own money, except that you are limited with your own capital. So some of my students start off that way. They might buy a building that's the husband and wife could afford with their own assets, their own balance sheet, and they might buy a 10, 20, 30 unit building, or maybe even a 50 or 60 unit building, depending on their own individual means.
Yep.
But then they're stuck. And so prior to meeting me, they would think, well, we're stuck here. We're going to wait 5 years, sell our building. They come to my training, and then they realize that, no, they're not stuck anymore. They could leverage that experience. They have a proven track record. They can go out and raise money from other people and go out and buy more deals. And look, they're helping themselves, they're helping their investors, and they're transforming the communities that they own. So it's a feel-good business all the way around.
So speaking of communities, let's talk about geography, right? Apartments are in a lot of places. How do you find markets that seem to make better sense for apartments than maybe other markets?
Well, I've personally researched a lot of markets, Robert, but there's no way I could research them all.
Right.
So I came up with a recipe, just like buying an apartment building. There's a recipe. There's a proven step-by-step process, and it's the same with finding a market. So some of the things I look for is, first of all, is it a landlord and business-friendly environment? If the tenant doesn't pay, they can't stay. And there are certain cities or states or municipalities that it's just really hard to evict somebody that doesn't pay.
Absolutely.
So there are other markets like Texas and Colorado and Florida are just 3. They're not the only 3, but those are 3 that it's fairly easy to get somebody out if they don't pay. And as a business owner, that's important. For those that want to be charitable, they can do that with their own money, but not with their investors' money, right?
Well, this is critical because you don't necessarily think about that. People think, well, I want to invest where I live or in an area that seems strong. But tenant-landlord law varies greatly between jurisdictions. So understanding that is huge. And then the business-friendly nature, right? Because here's the deal. If you have leverage, you need to make that payment even if your tenant isn't making their rent.
That's correct. And other things I look for in the recipe, has there been job growth and is there continued projected job growth? The same with population growth. So if we see, high population growth or positive population growth, positive job growth, business-friendly, landlord-friendly environment, and I also like to look at the pricing relativity formula. If the single-family home costs $1 million for a 422 in maybe a certain place in California, and then you could come to Texas or Oklahoma or Indiana and buy that same house for $200,000, that's also a good indicator of, where I believe the sweet spot is for multifamily, is buying deals that are going to make you a double-digit cash-on-cash, because you could buy deals in some of these expensive areas, and you're really buying for appreciation or the hope of appreciation. But I don't buy based on a hope of appreciation. We buy based on cash flow and a proven, predictable capital gain based on realistic underwriting.
Our guest today is Brad Sumrok. He's an investor in multifamily properties, and he teaches other folks to do the same. Before we're out of here, we're going to share how you can come attend one of his trainings. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Memphis, Tennessee is a market that delivers in more ways than one. As home to FedEx, Memphis is one of the largest distribution hubs in the world. That means working class jobs. No wonder Memphis is one of the best cash flow real estate markets in America. And the guy in Memphis who can deliver great, affordable cash flow turnkey properties is Terry Kerr at Mid-South Home Buyers. Contact Terry through the resource section at realestateguysradio.com. And be sure to order Terry's tips for turnkey rental property investing. It's free. Just send your request to turnkey@realestateguysradio.com. That's turnkey@realestateguysradio.com. Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hey, this is Phil Collin from Def Leppard and Delta Deep. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for listening to the show. Today we're talking about apartments, investing in apartments versus single-family homes or any other investment you might make. Before we get back to our interview with Brad Sumrok, it's time to play Real Estate Trivia. Your chance to win a prize by knowing today's Real Estate Trivia question. In just a minute, I'm going to ask you a trivia question that has something to do with real estate, and you're going to quickly send us your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. Include your name and your mailing address so that if you're the winner, we can send you a copy of the ABCs of Real Estate Investing. That great book by Ken McElroy can be yours if you know today's real estate trivia question. Last week it was Ask the Guys, and we gave away a copy of Second Chance. To this trivia question, name the largest lake in England. It's a pretty short and succinct real estate trivia question. There's only one answer. It's Windermere Lake. Lake Windermere in England, its largest lake. Here's our real estate trivia question for this week. Nearly 1/2 of the world's production of walnuts takes place in one country. Which one? Which country leads walnut production in the world? If you know or you just want to take a guess, send us your best guess to trivia at realestateguysradio.com. The person with the right answer is going to win a copy of the ABCs of Real Estate Investing from Ken McElroy. That's today's real estate trivia question. We're talking with Brad Sumrok today about investing in multifamily. It's not as hard as you might think. In fact, as Brad demonstrates, sometimes it's easier to invest in multifamily. Brad, let's talk about the kind of the nature of the buildings, right? You hear people talk about what A-class, that's some of the nicer, top-of-the-line buildings, B-class, C-class. Is there an area that you specialize in, or does that matter?
Well, there is. And to me, the sweet spot, again, and my goal and what I teach others is that you're looking for double-digit cash-on-cash returns. So there's nothing wrong with buying a property, but that's what the REITs buy. And if you invest in a REIT, you're going to get a single-digit return. So single-digit returns are better than no returns, but they're not going to help you retire in 5 years or less, okay? And if you remember the rule of 72, I'm sure a lot of people know that. So you want to maximize your rate of return. So the C-class are generally 1970s, 1980s, maybe 1960s property, and they're occupied by a working-class demographic. And so that is a sweet spot where most of the REITs and the big companies are not competing, and they're not buying that market. They're buying the A's and the B's.
Yep.
Okay, so the individual investors like us, the people that could pull a little bit of money together or go out with your own money and buy a building. You could start with 10 units with your own money, or you could do 300 units in a syndication. And that's the sweet spot. So that's the Class C. I've progressed into buying Bs just because they look nice, and you can show your friends your property and be proud of them.
Right.
But they make great returns too. But the Bs, you really want to make sure that you always want to make sure you're buying it right, whether it's a B or a C. And a B is just a property that's a little bit newer and a little bit nicer than the C, and it also has a little bit higher quality demographic. And by higher quality, I mean, education levels, income levels. So the A's are the professional class, and that's, we don't buy those. The rates of return are too low, and you're competing with huge hedge funds and Wall Street and companies that own hundreds of thousands of units. So the little guy, which is what I do and the people that I help, that's our sweet spot, are the C's and maybe the B's.
And let's talk about deal size, because you talked about a 32-unit property, and you also showed us some couple of hundred units. What's kind of like the biggest property you have, smallest? What's kind of the range people look at today in multifamily?
I started with 32 as my first one and went up. In 2015 alone, my students did 25 apartment complexes. The smallest was 10 units,
okay,
and the price was $300,000. The largest was 305 units, and the price was about $14 million. The truth is, my students, most of them start with no experience, or maybe they had single-family experience and they decided multifamily was the next step, and they did somehow graduate. But most of them, after they hear at an event like this, or maybe a training seminar, they realize that they can get into this and they don't have to start with single family. So yeah, between 10 and 300 units, a good size starter property might be 60 to 70 units. And why 60 to 70 is because that's, to me, the minimum size where you could really get a manager or a maintenance person in the management company, and that actually makes your life easier. It's easier to do 60 than it is to do, say, 30. And even though 32 was the first one I did, and I did well with it, it would have been easier to buy 60.
Interesting. Another paradigm. You think 10 units is easier than 60.
Yeah.
Other way around, right? Efficiencies, economies of scale, vacancy being spread out before more units, all that kind of stuff.
That's correct.
Now, let's talk about your students. Who comes to you, and who's kind of your ideal person that comes and says, you know what, I want more, I want to put away money through real estate investing? Who's kind of the Brad Sumrok student?
Well, the Brad Sumrok student is somebody that, like me, I had a college degree. I made decent money. I wasn't rich. I wasn't poor. Okay, this is not no money, no credit, no problem. And
right.
I need to say that. But if you have decent credit, if you have a little bit of money, you don't need tons of money. You don't need all the money to do it yourself. But it's, say, a professional class person, not necessarily needing a college degree, but maybe someone that makes in the high 5 figures or low 6-figure income, has decent credit. That's my ideal student. Somebody that's been investing in conventional investments and may feel frustrated. Somebody that, what I used to do, Robert, I used to put my money in my 401k and pray when I opened up the account statement every month that it went up. Those are the people that come to my training because they want to make better returns. They want to get out of the rat race. They want to make a positive return on their investment, and they want to have more control over their investment, and multifamily offers that.
Absolutely. Well, let's talk about the training. You every so often get together a group of folks, over 300 last time. Tell us about the training that you do. You've got one coming up in Dallas, Texas in March.
That's right. So it's March 12th and 13th, and it's a weekend training. And I do my own training events, and I teach the whole event. So this is not a multi-speaker event. I teach the whole event. I've been doing this for 14 years. I know enough, Robert, to walk people through the entire process.
Right.
Now, obviously, when you're buying a deal, I'm going to refer you to service providers with proven track record. But my events, I do them 3 times a year, generally in March, July, November. The next one is in March 2016. We actually do a bus tour as well on Sunday morning, a half day. We put everybody on a coach bus, and I will show you properties that either I own or one of my students have recently purchased. So, there's nothing like seeing and feeling, and I might even say with a smile, smelling these properties. And They don't smell bad, by the way, but, there's nothing like the experience of actually getting out there in the field to see the deal, and then it's complemented with in-class training.
All right, good stuff. So before you're done today, we're going to show you how you can get signed up for Brad's training. Now, you've mentored a lot of folks, talked to a lot of people. What are some of the mistakes you see people make when they're eager to get into apartment investing, but they miss the turn?
Well, I had a mentor when I started, so I didn't make a whole lot of mistakes, but I see people making mistakes, and one of them is just trying to do it yourself. And, whether you have a mentor or not, obviously it sounds self-serving, but I think having a mentor is important, but you want to leverage other people's experience. And one of the things I teach in my training is leverage is important. Leveraging not only other people's money to fund your deals, but what about other people's experience? I don't go to 20 banks. I go to a mortgage broker that knows 20 banks.
Right.
I don't call 20 attorneys. I go to 1 or 2 that I know that have a proven track record in real estate. You don't want to have the attorney that did your personal will be your real estate attorney. And a lot of people do that. They use their friends, they use their family, they use their single-family realtor to help them find apartments. And that's a mistake, I believe, because you're not really leveraging somebody that has what I call a level of mastery in multifamily. So you want to build a team with people that have multifamily experience.
You know, a couple weeks back, Brad, we did our predictions of the year, which isn't us predicting. It's going to all these different sources of folks taking a look at the beginning of the year and saying, all right, this year's going to look good, bad, or different for real estate. One of the concerns in multifamily is just that cap rates have been squeezed down a little bit. Yet this is a long-term asset. We have more people renting than owning today. So paint us kind of the big picture on multifamily and what you see in the coming years.
Well, I've been fortunate that I've been in this business since 2002, and I've seen the market go up, and I've made a lot of money, and I've been in the market when the market went down in 2008, and I made a lot of money, truthfully. I didn't go out of business, and I'm not one of these people that was like, oh, I was young and I made tons of money and I lost it all, and I'm going to teach you all my mistakes.
Right.
I mean, yeah, that's great, but it's like, wouldn't you rather talk to somebody that didn't lose all their money in 2008 and 2009 and 2010? To me, it's all about having realistic and conservative underwriting. You don't want to underwrite a deal, which is a financial model of a deal, based on, say in DFW, you have 8% rent growth today. Well, you'd be crazy to project that out over a 5-year period.
Right.
So I look at historical growth rates, and I model the property based on historical growth and historical occupancy, and not what's actually happening today. And my experience is, when you do that, and if you do go into a downturn, which I can't tell you when it's going to happen.
Unfortunately, you won't learn that at the training, when it's going to happen.
Yeah. No. And if I knew that, I don't know if I'd be here. I'd be doing something. But the point is that conservative underwriting will get you through a downturn. Okay, we've had deals where we bought at the last market peak in 2008. We made money, but we held them a little longer than we projected. We held them for 7 years, and I like to get in and get out within 5, for example. But, there were some deals that we held a little longer, unfortunately, because we had long-term financing at a fixed rate. We were able to weather that downturn.
Well, in fact, financing is one of the pros of this particular niche because it's pretty good and it continues to be affordable.
Financing, I will say, is still awesome. I mean, we've just done some deals personally that I've been involved with, under 5%, fixed rates for 12 years. You have the ability to go back to the lender and pull out equity as the value goes up several times. Amortized over 30 years, 80% of the price, the rehab, and some of the closing costs. So the conventional and non-recourse, by the way. I mean, imagine having no personal liability on a $22 million loan.
Yep.
Or if you're a beginner on a $2 million loan.
Well, we sure appreciate your time today and the passion for teaching what you do. That's good stuff, my friend.
Awesome. It was glad to be here, and it was a lot of fun.
All right, there's Brad Sumrok. More when we come back from the Real Estate Guys in Dallas, Texas this week. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com or look under the events tab at realestateguysradio.com.
Hi, this is Donald Trump, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Boy, I feel richer just talking to Brad Sumrok. What a nice guy.
One of the things that I love, and there's many, many things I love about being the co-host of the Real Estate Guys radio show, but getting a chance to get around people that are just at a high level of practice in whatever it is they do, right? We get a chance to get around subject matter experts that are really, really good at whatever their particular niche is. And of course, in this case, Brad, we'd heard about, we'd been following, we've attended some of his events, and just really impressed with the detail of knowledge. This guy's got a background as an engineer, detail-oriented, but he loves to teach. And it's just the real deal. He practices what he teaches, and he teaches things that are actually making a difference in the lives of people. We attended a conference where Brad was speaking, and we got a chance to visit his booth, and he had several of his students actually volunteering their time for free to give back because they felt like they had received so much value from Brad. And you just got to love a guy that has that kind of a following.
Yeah, clearly he's passionate about it. I mean, we spent a lot of time off mic, more than we spent on the mic, and the guy's passionate for it. He's got some really, really great practical stuff. So he's got this training coming up for 2 days, and part of me is like, well, how can it take 2 days to teach apartments? But then many of the ideas that he gave were just seat knowledge, meaning here's a guy that's been through every part of the process, from researching the markets to looking for providers and brokers that are the right ones, to weeding out between all the information you might get and the packages you get, to making offers and negotiating, to walking the units and understanding the physicality of apartments. And he's rent rolls and third-party management. He also, as he mentioned, after he owned 1,000 apartment units, bought a single family house.
Well, this is one of my favorite things because for so many people, the assumption is, hey, I'm going to start with a few single family homes and then I'm going to move up to apartments. And probably before meeting Brad, I would have said, yeah, that's the way to do it. And then you meet him and you're like, well, maybe not. Maybe it's possible to go directly to the top. I kind of like that. In the old game Chutes and Ladders, if you rolled right, you kind of shot up right up to the top. Like I always wanted to roll and land on that spot. And so to hear Brad say that not only is that's what he did, but he's been able to teach his students how to do that, that's impressive.
Well, this will give you a little more insight into Brad, because the reason he bought a single-family rental house after being successful in partnerships and on his own buying multifamily, why would you buy a single-family house? Here's why. He had been teaching for a couple of different groups. He would occasionally come and talk about apartment investing, what he did, and he was asked to lead a course on single-family investing. And he thought, well, I mean, I've been an investor a long time and I've done that, but I don't really understand single family. I mean, I live in a single family house, right? So he literally went out and bought a rental property so that he felt he could stand in front of the room and talk about single family homes.
Well, you learn by doing. I mean, that's for sure, right? But I mean, that, again, to me, very impressive. A guy that is really taking a lot of pride in making sure that he's walking his talk.
It's interesting. We talk about real estate syndication, which Brad has done a lot of, as a way that you can do more deals than your wallet allows. Well, for Brad, even though he does syndicate some deals, and that's one way, the other way he does it is by teaching. I mean, this guy gets as much of a kick watching his students go out and do this as his own portfolio, it seems like.
Yeah, well, I can relate to that. You and I have been teaching together for what?
Seems like forever.
I think it's been 14 years. We've been together for 14 years now, and 10 years doing our monthly mentoring clubs and the seminars we were doing and all of that. And it became apparent to us that the hunger for knowledge was so great that it was going to exceed our ability. So rather than just teach out of our own knowledge base, that's where we started reaching out and looking for guys like Brad, Kenny McElroy, other people, Gene Garino, people that are doing very specific niches and doing them really, really well, and asking them, please come share with our audience, because we've got people out there who want to be at your level, and we can get them started, we can get them enticed, but we can't take them to where you can take them. And so it's really fun now to go out and find these people. I'm learning every day, and I think that's why I never get tired of doing this. And I think, I've learned as a teacher, I learn by teaching. When I sit down and do financial strategy or teach sales, those are kind of my two areas of expertise. When I teach that to people, I learn. I get more clear and more focused in my thinking. And I see that in Brad. I see that Brad is the kind of guy that really enjoys not only sharing and watching the light bulb going off for his students, but he also likes what's happening inside himself, where you get sharper, you get more clear, you get more precise in what you're doing. It's just a ton of fun. And we love hanging around guys that are experts at what they do, and even more so when they love to teach it.
So if you're interested in multifamily, obviously you should consider coming out to his course. The only thing that's crazy about this course is it's so inexpensive. I mean, he literally could charge a lot more than he does. And maybe that's just because he doesn't need the money. Well, whatever it is, he's got a great course coming out, 2-day course, March 12th and 13th. Get all the details on our website at realestateguysradio.com under events. A couple of closing thoughts on apartments, right? The difference of making the jump. Hopefully at least Brad's giving you the concept that, I can do this, that it's possible. He talked about a couple of really interesting things. The whole idea that it might be easier to own 60 units than 20 units. Just think about that as you're making this mental jump to be an apartment owner. A smaller apartment building of 10, 15, or 20 units is as much work as maybe one that has 60, 70, 80 units. So as you're thinking about it, and this also creates the opportunity for a sweet spot as you're looking at buying an apartment, the 500, 600, 700 unit, guys like Brad are buying those. You're probably not starting there. But there is this sweet spot of 20 to 50 to 100 units where there aren't as many competitors. The big dogs aren't playing. The institutions aren't buying those properties. And yet they're big enough that they fit the loan parameters available. So there can be a real sweet spot there.
Yeah, I think one of the things, and it really has to do with psychology and just some practicality, right? When I used to teach at the GRI program for the California Association of Realtors, I'd get a lot of realtors coming into the class. I was teaching finance. And, I'd poll them and I'd ask them, what's your niche? Where are you starting? And I was looking for the realtors who were interested in selling investment property, right? I get a lot of people, well, I want to do that somewhere down the road, but right now I'm starting with single family homes. My conclusion was I'd have 70 people in the class and 65 of them were going to specialize in single family homes. I said, do you understand you're going in the crowded door?
Right.
Everybody is going into single family homes because they think it's easier, but it's not easier. It's harder because it's so crowded. If you would just expand your thinking and specialize your training, you could go into the investment niche and you'd have it largely to yourself. This is a passion your dad has had since forever. This comes up a lot when we talk to people who are in the space. They realize, why aren't more people doing this? And I think a lot of times it's because psychologically we limit ourselves. Got a chance to talk to Tom Hopkins once and we asked him for a piece of advice. And I believe he did this the very first time we interviewed him on the show. And he says, you have to sell in the place where you feel worthy. If you feel like, hey, apartment buildings are too big for me, I couldn't do it, then you're probably not there. But I'd also encourage you to think like Brad and realize, hey, you know what? Maybe I could do it. And if I could do it, let me put my education into really learning how to do it and then go really try to do it. Because to your point, it is a sweet spot. When you're in that mid-range, you're not competing with all the mom and pop investors that are starting in single family homes because it's quote unquote easy. And you're not competing with the giant REITs who can't be bothered with a 60 unit. They won't look at anything less than 120 or 150 or even 200 units, right? So there's a place where you can actually go in and compete that isn't as crowded, and it could in some ways actually be easier with the right education.
Now, in addition to Brad's training class, which you'll find on our website, he's prepared a great little report for our listeners. If you're interested in learning more from Mr. Sumrok, just send an email to Sumrok. That's S-U-M-R-O-K, Sumrok, S-U-M-R-O-K at realestateguysradio.com. One last caveat, and that's this. We didn't talk a lot about financing because of the time, but many times apartment lenders have a minimum. So folks go, I found this great 8-unit apartment in this really inexpensive place I can buy for $225,000. Excellent chance you won't find a loan on that property because apartment lenders have some minimum, often $500,000 or $1 million. Again, get with a great lender before you buy any property so you know how leverage can work on that property. Big thanks to Brad for his time and for also his appearance at the Secrets of Successful Syndication a couple weeks back. Next week on the program, we'll be talking about the Dallas market. So we have between now and next week to go figure that out, and we'll bring that to you next week. Until then, go out and make some equity happen.
Hello, this is Robert Kiyosaki, and I'm very excited, and I'll be joining the Real Estate Guys for their Investor Real Estate Summit at Sea. Join me, join the Real Estate Guys Investor Summit at Sea, and I'll see you out there.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.